Good morning and welcome. My name is Peter Warda with the Santa Clarita Valley Chamber of Commerce, and I appreciate you all joining us. Before we get started, as always, please make sure you're using your questions box in the control panel throughout the webinar. As you know, at the end of the presentation, we'll do a Q&A session. So we'll do our best to get to all of your questions and answer them, but please, as we move through the presentation, go ahead and submit any questions that you may have. Also, don't forget to continuously check our events page for all our upcoming programs. So with that, we're going to go ahead and just jump right into our webinar. So as you all know, there's always a debate over whether our tax rates should be progressive or flat. You know, you have politicians who support a flat tax, argue that a single tax rate for everyone would greatly simplify the system and taxpayers' lives. And then you have politicians who support progressive tax rates, argue that it's unfair to ask a person who with only modest income to pay the same percentage of their earnings as a wealthier person. So today we're joined by John Vance, who's president of Vance Wealth and the 2021 Chamber Chair, who will provide us with education and guidance on understanding current taxation, the Biden proposal and how it may affect you, and then some tax planning strategies. So for those of you who don't know John, I'm going to do a quick background on him. John is both a certified financial planner and certified financial planner professional and a certified divorce financial analyst. His plan-driven approach has been a major factor in helping his clients reach their financial goals and feel confident in their financial future. Just last year, John was named to the 2020 edition of Forbes list of best in-state wealth advisors. And so with that, I want to go ahead and turn it over to John, who'll get us started on our webinar. So John, it's all yours.
Awesome. Thanks, Peter. Thanks for having me. I know sometimes this topic can be very dry around taxes, so I'm excited that you're here to join me for this topic because there's a lot going on out in the media and clearly with some of the new changes that are on the horizon. I think most people are curious about how this is going to impact them personally and how it's going to impact their business. And so, today really is just kind of to give you a background on taxes and what some of the tax policies are and just kind of understanding that's the taxes 101 piece of this. And then I also want to share some of the Biden tax proposals. We're getting clarity around what's coming down the pipeline. So what we're going to discuss today is really what has been thrown out there, and but there's going to be changes. And so when you're dealing with any tax changes, it's always a negotiation. And so just what I want to try to do today is I do have some opinions about some of the tax proposals, and some of them are positive, some negative. So I will share that. But I try to stay out of the politics, and it's really hard to because it's a tax conversation. But hopefully you'll find that I'm fair and accurate with my assessment. And then what I'll probably do in the next several months is once we get some more clarity on the tax proposals of what's actually passed, then we'll delve into a deeper conversation as well, how does it impact your business, and then what changes might you want to make going into year end. So today we're going to focus on what's on the horizon. And so just real quick from a disclosure perspective, we don't do tax preparation. We don't provide tax advice. This is more just planning guidance and education around taxes. So hopefully you'll find this valuable. So let me just walk through some of the basic info around taxes. And we will make this slide deck available. I'm not going to read every line item. I just want to make sure at a high level that we have a pretty good understanding of what some of the taxes out there and what they are and how they impact you. Certainly not going to cover all of them, but some of the major ones that are probably on the docket for some adjustment, for some changes. So capital gains tax. So capital gains tax is basically a tax that investors pay on the growth of their investments when they decide to sell those investments, right? So that could be, it could be real estate, it could be stocks, it could be mutual funds, ETFs. And so these are taxes paid when a transaction is realized, meaning it is sold. So the important distinction on capital gains tax is you have two different buckets. You have short-term capital gains tax and you have long-term capital gains tax. So short-term capital gains tax are taxes on anything that you realize where you haven't held that asset for at least a year. So it's 1 year or less is considered a short-term capital gain. And when you have a short-term capital gain, then you're actually going to pay at your ordinary income level. So whatever bracket you're in, whether you're in the 12% bracket or the 32% bracket, and there's actually 7 tax brackets, then you pay at an ordinary income level. based on all of your income combined. If you do a long-term capital gains, which are anything as 1 year and greater, there's some distinct advantages because you have capital gains rates which can be taxed at 0% long-term, 15%, and the maximum is 20%. So there's actually a separate breakdown from a capital gains perspective in terms of what tiers you hit if you're a single filer or if you're a married filing jointly filer. So you have 0, 15, and 20, with most people falling into kind of the 15% level. So that's the capital gains tax. Social Security tax. So we all know this Social Security tax because these are taxes that are deducted from our W-2, or if you're a business owner, these are taxes that you pay on behalf of your employees. And so these are, again, taxes borne by both sides. And if you're self-employed, you pay both sides of this. And so the current tax rate for Social Security is 6.2% to the employer and 6.2% for the employee. And the wage-based limit, which means how much you have, how high do you have to pay that Social Security tax, or what threshold up to, and it's $142,800. So what that basically means is that everyone who is a W-2 worker will pay on their first dollar of earnings 6.2%. Their employer will pay that same 6.2%, and that goes all the way up to $142,800. And then if your income exceeds that, then you don't pay any more additional Social Security tax. And obviously that money is used to go into the Social Security Trust Fund to pay for future Social Security benefits. You also have, as part of this W-2 deduction, and it goes beyond Social Security, but it's a Medicare tax. And again, this is another area where employees and employers pay, and these are taxed, again, through payroll tax. And the current rate for Medicare is 1.45% for the employer and 1.45% for the employee. There is no wage-based limit. So basically, there is no cap. So as your income goes higher above that threshold to 200,000, 300,000, 400,000, there is no cap. It continues to pay on the way up. And then there is also an additional Medicare tax on wages above 250,000 if you're married filing jointly. That's what that MFJ stands for, and 200,000 if you're single. So they added some additional Medicare tax to pay for some of the additional costs that Medicare, primarily with the Affordable Care Act, otherwise known as Obamacare, that was an additional tax that was added. So hopefully that gives you just a little bit of breakdown of some areas. Want to cover some real basic. I'm going to be quick on this. Property taxes. Obviously, this is tax that is paid on real estate or other certain types of property. It's actually one of the primary sources for local and state governments. And you can see the note there on California. The overall property taxes were slightly below the national average, but with the rates around, it's around 8.8% up to 1%. And again, that's after some exemptions. And then the sales tax. Obviously, a sales tax is then imposed. It's kind of also known as a consumption tax. You pay a tax based on what you consume, what you purchase. And you can see LA County sales tax is 9.5%, which is one of the higher ones around the country. So those are some, what we would know more as consumption tax, right? If you buy a piece of property, you're going to pay the tax. If you buy any goods, services that have a tax associated with it, then you pay a sales tax. Those are some basics, obviously, that most know. There's some other areas when you start getting into a little bit more complexity around maybe more wealth, maybe transferring of wealth. There's something known as an estate tax. Some call it a death tax. Some call that an inheritance tax. And so the estate taxes are taxes on a person's assets after death. And currently, the federal estate tax rate is 40%, but there is a big key exemption. It's only if the assets of the deceased persons are worth more than 11.7 million. So that's per individual. So if you are an individual, anything above 11.7 million will be taxed at 40%. And if you're a couple, then you can double that, right? So currently, California has no estate tax or inheritance tax. That has actually been something that's come up in the California legislature to really to figure out should we be adding that additional cost. But as of now, there is nothing in place. And then, so that's the estate tax side. And, that doesn't really hit a lot of people. It does hit a lot of business owners that maybe they built their business and they're passing it to the next generation. But because of those exemption amounts, it doesn't impact a high percentage of Americans. There's another important area when it comes to kind of this inheritance issue is something called a step up in cost basis from death. So a step up in basis is basically a readjustment of the value of an appreciated assets for tax purposes upon inheritance. Real simple example of that is if you think about any of you or maybe your parents or grandparents purchased a home in California in the 1950s or the 1960s. They probably paid somewhere around $20,000, $30,000, $40,000 for it, maybe even less. And when you inherited that or when that was left to the next generation, maybe it was worth 500,000, maybe it was worth $1 million. So basically what happens is when you leave an asset through inheritance, and I'm using real estate in this example, you get a step up in basis, which means the adjustment of value is basically the date of death value. So if you purchase it or your family purchased it for, let's say, 50,000 and it's now worth 500, and let's say your parent passes away, leaves the money to you and to your siblings, then your new basis is 500,000, which means if you go out and sell it the next day for 500,000, you would not have a capital gains tax on that because you got a step up in basis. So the reason why I'm mentioning these areas is there are some proposals out there about making some adjustments, and we're going to go through that today. So what I'm first going to go through before we dig into some of the proposed changes is just give you a little bit of history of, where did taxes come from? What is the revenue source for the US? And so if you look here, this is a 2019 data, and I'm just going to work our way around this pie chart, but you can see individual taxes and essentially individual income taxes represent 41% of all taxes from a revenue perspective. Social insurance taxes, which otherwise are known as Medicare and Social Security, are about 25%. Consumption taxes, which we did discuss, is around 17%. Property taxes at 12%, and corporate taxes at about 4%. So one of the things to remember from this slide is corporate taxes are only 4%, and that's a big hot button right now, is trying to raise corporate taxes. But you can see it's fairly insignificant relative to the overall kind of pie chart in terms of where revenue is derived from at this moment. So then the next thing is, okay, well, where does the money go, right? So we just showed you the money that comes in, and that was more on a national level. Well, this is where our federal government spends the money. So a little bit dated. I love this illustration because it's just using a dollar, so it's a nice visual. But it's an older budget. It's 2017, but it's not going to change too much. And you can see the breakdown. So Medicare, Medicaid, and other healthcare is about 28%. Social Security is around 24%. So this is all done under what would be known as major entitlements, right? So that's a total of 52%. Income security, another way of known as welfare programs, is around 17%. National defense at 15%. Net interest, which is the interest expense that our government has on all the debt, is 7%, and then all other 9%. So what I always find fascinating about this breakdown is you can see these major categories of money that needs to be spent at the government level. And you think about all the government entities out there at the federal level, and basically 9% of the budget goes to the rest, to all the other. So we spend a lot of times figuring out or trying to figure out where to cut money, whether it's from the defense budget, whether it's from welfare, whether it's from other items. And you can see, just looking at this, Medicare, Social Security, and interest expense, make up only 60%. So it does and I'll spend a little time at the very end about, how do we fix some of these issues around our spending challenges that we have, for lack of a better term. But you can see almost 60% is kind of mandated through Social Security, Medicare, and net interest expense. So this is then this is from the Congressional Budget Office, and this is the forecast for basically our spending plan and our borrowing plan. Now this one looks really unique to us. We've always been running deficits, and you can see on the right-hand side of this, it shows the borrowing piece and how much we're borrowing. I mean, yes, we've been borrowing money for the last, hundreds of years. It's really accelerated over the last 20 years in terms of how much we're borrowing to run our government. But this is truly an anomaly, and a big part of that is coming out of COVID, the response that's necessary at the federal level. And so you can see the amount of borrowing, and we can probably debate how much is necessary. That's really not the time or place for today's conversation. I love those conversations, but for today, we're going to try to stick to the facts and what's happening. But you can see the projected spending is almost $7 trillion. And you can see the other item on there, and a big chunk of that is coming through some of the stimulus, which again is unique to this year and last year. and then you can see the borrowing. So you can look at where those income sources are coming. Corporate taxes are picked up on there. It's really small on here, but it shows you 2%, 164 billion, and the amount of borrowing. And so I think that this is what troubles a lot of individuals is, that borrowing number is massive, right? And likely not sustainable. So how do we address that? And again, at the very end, I'm going to kind of go through some of my concerns and maybe some solutions. This is also like their baseline forecast of where things are headed. So you can see this shows annual budget surpluses or deficits. We mainly have deficits, except if you look in 2000, which you can see on the chart says 00, and you can see the bar graph actually goes below the line. So that means we had a surplus. So that was a short time, kind of at the end of Clinton's presidency, we had a nice surplus, which basically had a lot more tax revenue come in. And a big part of that, a big driver of that was some spending discipline. We also had massive amounts of capital gains coming into the government, kind of in that .com era where there was a lot of capital gains and a lot of wealth creation. And then you can see kind of the path we've been on for the last 20 years is where the deficits have gone up, and there's been some key issues that have hit those deficits, right? We had September 11th, which then kind of pushed us into driving spending more as a government, dealing with more defense spending, and then you can see there's a spike up around 2009, 2010, and that was helping us get out of the financial crisis. And then you can see the more recent spike for 2020 and 2021 of dealing with COVID, right? And then you can see it pretty much falls off the cliff, at least by projections, and it starts going into decline. But when we look at this next 10-year period, even though it's a decline from where we are today in terms of our negatives, it's running negative at a really high rate for the next 10 years. So obviously that's not a great thing from a forecast, because that just means we're building more and more debt. And this is a chart that a lot of economists point to and really talk about what's called net debt, which basically they're looking at the total amount of debt at our federal level divided by GDP, which is gross domestic product. And what we're trying to look at is, well, how much debt do we have relative to the size of our economy? So this shows that, we had that spike up in the 40s, kind of post World War II America, where we spiked up to 100% of debt relative to GDP. And that was kind of the rebuilding post-war. And then you can see we saw debt plummet, and we've been on the rise since essentially, let's say 2008. And so we're getting to some levels where economists, above 100% start to get worried. And that is a concern. So, the goal of the government is going to be to just how do we bring that back down, because it's not sustainable. Because what happens is when you get your debt too high relative to the size of your economy, then it's really hard to pay for it. And too much of the government's taxes have to go to pay for that debt, pay back the debt, or at least service it. And so that becomes a challenge. And so this is going to be something that not only this administration, but several administrations in the ahead are going to have to tackle. And unfortunately, in my opinion, the last 20 years, really neither party has really tackled this issue. And, we've had issues around why this is going up, but no one really seems to want to handle the spending issues because it's not popular, right? All Americans have a sense of like, when there's stimulus going out to individuals, there's money going out to pay for programs, to pay for the military. There's different things that as Americans we champion, and we're okay with the government spending money. Then there's things we don't want to, and so I know we all probably disagree on what those are. But one of the challenges we have is we know we all need to agree that it's not sustainable to be spending at this rate. So we got to rein that in. And my last slide in here actually addresses that, so I'll spend a little bit of time on that. Okay. So we're going to dig, hopefully this slide, there's a lot of noise on here, but I wanted to go through really the next, I believe, 3 slides. It's going to be what's in the Biden's tax proposal and how it may affect you. Now, from a policy perspective, depending on what you read, what I've been seeing is a lot of these scare tactics around the Biden tax proposals are terrible, dangerous for our economy. And I'm really not here to shed a lot of light on that. Because I think really we want to wait until things are passed, and then we need to assess that a little bit more. But I am going to give you my opinions today. And the key thing to know is, I think if we all understand negotiating 101, what Biden did, and probably smartly, is he put out there a lot of controversial tax policy changes that I think will frighten a lot of, let's say, conservatives or higher net worth. Because some of these proposals are really going after some of these higher net worth, not from a wealth tax perspective, but using capital gains, using some of the tax breaks for real estate and adjusting those. And so I think from a negotiation perspective, my point of view is that Biden probably went out pretty far in terms of just let's throw it all out there, because now we can negotiate back to the middle and have some compromise. That's my sense. We'll see what happens. He does have the majority. That doesn't mean he can't make tax proposals absent of some Republican support, but having the majority definitely gives him a leg up to kind of push things through on the agenda that he was elected on. So let's just go through some of these issues. And I have on the left-hand side kind of the current law. In the middle is Biden proposal, and then I just have Vance Wealth. So VW is Vance Wealth opinion and potential impact. So again, it's my opinion, or my opinion only, or I should say Vance Wealth's opinion. But hopefully it makes sense to you. So, these might be some areas where we have Q&A that you want to bring some of these things up, and I'm happy to have conversations. So, corporate income tax rate. So currently under the current administration, the highest corporate income tax rate is 21%. The proposal is to go back to 28%, which was how corporate taxes looked prior to Trump changing them in 2017. So frankly, based on what I showed you on previous screens, corporate income tax rates are such a small portion of our tax rates that I really do look at this as mostly a political decision, because it's easy to hate the corporations, right? That's an easy target to say, you know, corporations need to pay more. It's really minimal, going from 21 to 28, minimal tax receipts. It's going to have a negative impact on corporate earnings, right? Because if you look at earnings, meaning, you know, when you buy stocks, earnings are what drive the long-term health. Profits drive the long-term health of stock prices. And so if you have a higher tax rate, that means earnings are going to drop. So it will have a negative impact on corporate earnings, just like it had a positive impact when they changed it to 21. This might, you know, potentially boost international investments, because they might get more money because they're in a more favorable tax environment. So again, I think this is mostly political. Probably going to get passed. I don't know what the number is going to be, but there's going to be this likely will be passed, maybe not up to 28, but something's going to change there. Then we're going to look at individual income tax rates. So the current highest rate is 37%, and they're proposing to go back to 39.6%, which was the individual top rate this was under Obama that Trump changed. So going back to that level, again, this to me is a mostly political decision, minimal tax receipts at that small of a change. And I think it's really kind of tackling the agenda of paying their fair share. And so I do have a slide a little bit later on how do we address the fair share, because that's a really complicated question, because it depends who you ask about the fair share. But this is likely going to change. I don't think there's going to be a lot of resistance. Again, it's not a ton of tax receipts. It is, you know, it could be if you make several $million bucks, it's going to impact you. But I don't know if it's a big enough move to be kind of shot down. And I think this is really the initial agenda, these two items of what really Biden wants to pass for sure. But again, I think there's a little bit more political decision. Now we're going to go through some of the changes in kind of capital gains and real estate. So capital gains. So right now, the maximum capital gains rate is 20%. So that means if you sell, let's say you have a piece of real estate that you've owned for 20, 30 years and you decide to sell it. And we deal with this with clients who are, let's say, cashing out of their homes and downsizing. A lot of them have large capital gains, and so they might not be high earners, but because they sell an asset, they have to pay tax based on where they are, right? So if they're downsizing and they have $1 million profit, then they could be subject to this, even though they're not making that much income on a regular basis. And so the rate of up to 20% is being proposed that capital gains, if you are any income above $1 million, you'll be taxed at ordinary income. So let me show you the numbers on that. And I know a lot of people think, well, that's not going to impact me. Well, it does. If you own a business that you've been building for your whole life, let's say 20, 30, 40 years, and you sell it and you built a nice nest egg, it could be worth 2 million, 5 million, 10 million, 20 million, whatever you built it up to. If you sell it under this new tax regime, you're going to pay ordinary income, which takes the rate from 20% to over 40. So it's a real punitive tax, and it's even, again, for that kind of aging population of people in California that, you know, have owned real estate forever and decide to downsize, this capital gains could ensnare them as well. So look at the numbers here. Massive tax increase from basically 23.8% to 43%. So that 55% increase, that is a typo. I needed to adjust that. So it's almost a doubling of the tax exposure. This could create a selling frenzy, is a little dangerous maybe, but it could really create an environment where people look at this and say, maybe I'm going to sell now so I don't have to deal with this. And so that's one of the challenges that, and I didn't mention this early on, so let me pause here and mention this. One of the things that we don't know is any of these changes, are they going to be on a go forward basis, or they're going to be on a retroactive basis? So if they're on a go forward basis, which means when the tax policy is now in force, then any decisions you make on a go forward basis will impact you. We don't think they're going to be on a retroactive basis, which means if you sold early in the year that you could have to pay these higher capital gains rate. We don't know yet. I did read an article from the Wall Street Journal just a few weeks ago that talked about Biden put his new plan in place, I think as of April 30th, and there's talk of making it effective as of that date. So the dangerous part of going essentially retroactive back to that date is that you as an individual, if you were going to sell your business or sell a piece of real estate to maybe not pay these higher rates, you're not going to be able to go back potentially. We still don't know. But again, I'll come back to that when we do a recap of some of the changes in the future. Personally, I think that's bad. This is a bad policy long-term for the economy. This is a pretty punitive tax rate. And I think there's, if they want to bump the rate up from 20 to 24 or 25, I don't think we've seen anything above 28 basically in the last 50 years. So I think jumping this number up to 43% in federal tax plus California on top of that is really not great for the economy in terms of the impact on basically capital moving and taxing business owners and real estate owners at that high level. So again, my opinion, but I don't think this is great for the economy at this level of an increase. Real estate. So there's a real famous tax code which involves what's called a 1031 exchange, and that basically allows you to exchange a real estate property for a real estate property of essentially, let's say, of equal value. It can be of equal or greater value, but by doing so, when you exchange the property, you don't have to pay capital gains, right? So if you normally just sell an asset, sell a piece of real estate, you got to pay tax on that, whatever your gains are. However, if you do a 1031 exchange, you basically can delay the tax or defer the tax to a later time. You don't have to pay it at the time of that sale because it's deemed as an exchange. So under the current law, you can do this and you have to meet certain requirements, but under the new rule, they're basically talking about that, this still applies if you earn less than 400,000, but if you earn more than 400,000, that you'll be ineligible for this capital gains deferral. So the impact is unknown. I don't think there's been a lot of study on this. I don't think this is positive. There probably should be some adjustments to the 1031 exchange because obviously, this you could defer taxes for forever, 20, 30, 40, 50, 60 years. But this is going to be a hot issue. I don't think this one's going to pass because I think there's too many constituents that are going to be fighting this issue. I don't really love this elimination. I don't think it's positive, but the impact it hasn't been fully studied. Social Security taxation. So this is another big one out there, which I don't think a lot of people know about, but will probably become somewhat unpopular. So current law is that Social Security tax for employer and employee is applied to the first $142,800. We discussed that earlier on wages or self-employment income. What the Biden proposal is opposing additional Social Security taxes on wages or self-employment income above 400,000. So basically what that means is from 0 to 142, you pay the Social Security tax, and then you have this like what they call like a donut hole, meaning from 142 to 400, you have no additional, and once you get above that 400, then that comes back in. So my notes below, I don't think I can hide how I feel about this. I think this is a terrible idea. And the reason that this is put in place is to fix Social Security. I've created a video about 6 months ago on how to fix Social Security. It's on our YouTube channel if you want to see it. This is not how you do it. Remember, Social Security is essentially a pension, right? It's a retirement benefit. So the reason why they cap it at 142,000 is that people's Social Security benefits are capped. So it makes sense, right? So so basically this is just a big overreach in my opinion. So let me give you an example. So if you're a successful business owner and you make a good wage, and I realize this is a lot of money. Let's say you make $1 million of self-employed, you'll pay an additional 12.4% tax, which would be an additional, under this code, $74,000 of income. And so I added up all the sources. So if this is you, your total tax bill would be $528,000, which is 53% of your income, which to me starts to get punitive. When you have to start paying in excess of 50% of your income in taxes, that starts to be counterproductive for a capitalist economic system. So you can see what the federal tax, the California state tax, the Social Security wage, and the Medicare. So it adds up to big numbers. And I rounded a little bit, but hopefully that gives you a little bit of clarity on how that would impact some business owners and some higher earners. So there are some other changes that are being proposed. This is around capital gains and death tax. So we talked earlier about this step up in basis where you get the readjustment of the value. Under the Biden proposal, this will no longer be permitted. You can see my note on there, bad idea. Like, this is a nightmare. The IRS is already understaffed, which I think most of us are okay that they're understaffed, but they're already understaffed. And so the reason why the step up in basis is so beautiful is that, you know, if you inherit an asset, you don't know what let's say you inherited a piece of real estate. You probably don't know if your parents owned this home for 20, 30, 40, 50 years, maybe what they paid. And not only what they paid, but what about all the improvements they put into the house? And that affects the basis. And so the beauty of the step up is it takes all that calculation out of it. You basically just get to have a do-over when you inherit that money. So again, this one I think is going to be so unpopular, and it impacts any American that inherits any asset. So this hits everybody. This, in my opinion, number one, is a bad idea. Number two, I think has very low chance of passing. The estate tax exemption. So we're currently at like 11.6 million per individual, and again, you get a doubling that if you're married, and then anything above that is a 40% tax rate. So the proposal right now is to reduce that down to 3.5 million. So that's a fairly hefty reduction, and that's about 8 million per person. So people who have built some estates up, this would have a pretty dramatic impact on them. And then also raising the tax rate up to 45%. So it's a kind of a double whammy. It's lowering that threshold, but it's also pushing the tax rate up. This is obviously not popular with high net worth individuals. I don't think it's terribly unreasonable. I don't mind the lower threshold. What I don't like is this punitiveness of 45%. I think if you're going to have an estate tax in place, put it at 25% or 20 or 30, something lower, because what happens is you put it so high. Well, successful attorneys, wealthy individuals, they find ways to use the tax code to basically move money and not have to pay these taxes. And so you get to these higher thresholds, you incentivize bad behavior. And so I think they got to take a different approach and say, hey, we need to keep the estate taxes. We're going to lower the threshold, but we're also going to lower the rate. We're still going to get a lot, and you probably would generate more money. So I'd love to see a study on that. Again, it's obviously not popular with high net worth estates, but I don't think it's unreasonable, but I think they got to rethink these numbers. Okay, so I know I did that really fast, and these will be recorded, so if you feel like watching it again, you can. I do want to get into some of just, some of the kind of, those are the facts, so now what? What's going to happen on a go-forward basis? And so don't have a crystal ball, but one of the things that I do think we're going to see, and it's not just the Biden administration, I think this is going to be consistent throughout any administration, is that we're going to likely have increased or enhanced tax enforcement, right? So there's a lot of studies out there that show that people are not paying their taxes. So even though the tax code is set up, that they're finding ways just not to pay it. So the proposal in the American Family Plan is for Biden to increase funding to the IRS by 80 billion over 10 years. You can see the next study, the White House study, found that the top 1% of earners failed to report 20% of their income and avoid paying 175 billion in taxes. Again, this is not my data. This is just data we gathered. Proposals would bolster the IRS enforcement and potentially, raise a lot of revenue over the next 10 years, basically by having these corporations, individuals pay the money that they owe. And again, and then you can see the average gross tax gap between what was due and what was collected was estimated around 440 billion for 2011, 12, and 13. And so that's obviously a challenge, right? When we have a set of tax code, whether you agree or not, we should be living within that tax code. And so if you have things that can, legally take advantage of the tax code and get a deduction, great, that's part of the tax code. But what we can't have happening is have a set of rules that some people follow and some people don't. It's just a dangerous tactic. And so the one thing that I think is going to happen here with the IRS is the two things I should say is you're going to see more money there, but we're also going to have really the advancement of artificial intelligence and the ability for a lot more screening by computers to pick up irregularity on tax returns. And so this is going to be really key for business owners, is have clean books. Make sure you have documentation for what you're doing, because if you don't, I think these are going to be areas where you could run afoul with the IRS. And so that's going to be a key factor that you got to make sure you focus on by having a good bookkeeper, keeping good notes, and being really well organized as a business owner. All right, so this is always a dangerous conversation when it comes to, do the rich pay their fair share? This would probably be a lot more lively in a non-webinar format and having you in for like a lunch and learn in our office, but I'm going to do my best here. So if we look at the fair share is kind of a little bit of a hollow argument because you can't really define what's fair. So let's just deal with the facts. So if we look on the right-hand side, we're going to start with this. And so the top 1% of earners earn 21% of the income, right? So that's a pretty heavy concentration, right? The top 1% makes 21% of all the income, but they pay 40% of their tax. So depending on how you look at that, the fair share camp would be, all right, well, they don't pay their fair share because they're only the top 1%, and they're earning 21%. They're just making too much money. The other camp would say, well, hold on, they're earning 21% of the income and they're paying 40%. Shouldn't they be paying 21% of that? So that's kind of the argument around this. And so you can see this, the fact that the data is here and suggests that, you know, basically the top 50% of earners essentially pay 100% of the federal income tax, and the bottom 50% pay 3%. So you can see that on the chart. So this is the issue of, you know, what happens if we get all the tax concentrated at the top level. You know, one of the dangerous policy decisions is if the bottom 60% and the bottom 70% don't pay any tax or pay minimal tax, you can start voting in a lot of tax increases because it only impacts a very small part of the population. But a lot of the top 1%, top 10%, you know, these are the ones running businesses, creating jobs, creating opportunity. And so it's really a dangerous game sometimes the politicians are playing on both sides with how do you make the tax system fair? Frankly, I would take the approach of leave the tax system how it is now, and we have a spending problem, not a tax problem. Now we can, again, debate where we should be taxing, but we have a lot of revenue coming into the government, and really the issue we're seeing is that there's just a massive spending problem that nobody wants to deal with, and that'll be the next slide. But we also know in California, which we're seeing some massive migration outside of California, going to states like Idaho and going to Montana and Utah and Arizona, Nevada. So in California, we have one of the highest income tax rates at 13.3%. And then you can see kind of the surrounding states, and then the gray states are the ones with no income taxes. And so that's why you're seeing migration to Texas, migration to Florida is because of these issues. And then we're gonna this is my last slide here. So, and then we'll do some Q&A. So this goes back, it only goes back to 1985, and it does do some projections in the future up to 2030. And what this basically shows is the red represents the spending by the federal government as a percentage of GDP. So it's always as a percentage of the economy, right? What is the spending? And then the blue represents the revenue, right? So these are the receipts that are coming in to the government. So when you look back in 1985, kind of up to 2000, you can see our spending tended to be around 20%. Our revenues tended to be around 18 to 19%. And you can see that was pretty consistent until about 2008. Then we had the financial crisis, and then you look what happened. We had the spike in spending, and we had a decline in actually revenue because economic activity was impacted, right? So if you have a slower economy, you generally will have less revenues. And then you can see the revenues were kind of on a mend through 2015 back to some normal numbers, and then we saw a decline again. And so when I look at this, one of the things is that maybe we need to boost revenue up a little bit, right? We need to boost revenue from a normal rate of, let's say, 16 to 17. Maybe we need to get closer to 20. So we should have a policy that focuses on that. But clearly, the biggest issue here is not the revenue piece, it's the spending piece. And through all of what we've been seeing, we're not seeing, in my opinion, much restraint on spending. It's just like, well, each party is, well, I'm going to spend this, and I think we need to spend more, or we need to bring back, you know, we need to do different levels of spending. But right now we're negotiating between should we spend $1 trillion or $2 trillion? Like, we're not talking about should we level spending off. And so that's really, in my opinion, how this is going to be fixed is through a massive amount of spending adjustments. And you can see what's forecasted on this chart is 2020. Obviously, we have a massive spike, not sustainable, and it's not going to be sustained. But you can see we still have an elevated spending plan for the foreseeable 10 years. And so that's going to be the big issue that politicians are going to have to grapple with. One quick thing, and our next webinar is going to be around this inflation idea, like what's happening with inflation. I don't have a great title yet. It might be the good, the bad, and the ugly, just kind of understanding what's going on with inflation. But you know, in our opinion, the government wants to create some more inflation, right? Because inflation is the rising of prices. So if prices go up, guess what? Tax revenues go up. So that's one of the ways to get our revenue higher, is to actually start creating some inflation. And so if they can level out spending and get inflation, get revenues up, this will fix some of the issues. But we're not seeing a lot of chatter out there about that right now. So real quick, we have a QR code. So if any of you are interested in just having like a 30-minute consultation with one of our wealth advisors, just to discuss how the tax policy might impact you, we're happy to just have a free consultation. Again, I'm a member of the chamber, and I'm actually the chamber chair, and be happy to meet with any individual that thinks that they would benefit from having a conversation. So scan the QR code, book an appointment with us, and then you can see my note down there. Our next webinar, chamber webinar, is going to be July 21st at 11 a.m. Inflation, the good, the bad, and the ugly. So these are our core values. So I think as a business owner, hopefully you appreciate, we all like to have core values, the people that we gravitate towards, the staff that we engage, the people that we enjoy being around. And so these are ours. Hopefully you guys have all created your own, because that's really helped us live by certain mantras and help our clients move forward from a business perspective. And without further ado, we'll move on to questions. So I think I went about 45 minutes, so hopefully we're good on time. So Peter, come on back, and hopefully we have some questions today.
Thanks for that, John. That was really, really great. And everyone, as John mentioned, John, I don't know if it's easier if we want to just leave the slide before this back up so people can get that QR code, if that's easier. We can leave that up for people to see. But as John mentioned, this is recorded, so if anybody wants to go back to get anything checked out, it will be up on our page. So we'll have that available for everyone. John, I do have a few questions for you. First one, I'll start with, it was the last one that came in based on what you talked about. I believe it was when we were talking about Social Security. Was there ever a final clarification on the 400,000, if it was per person or per household?
Okay, so I have been asked that question before, and I did not get the answer on that. So my understanding, though, is because, remember, Social Security is taxed at the individual level, that it should be based on the individual work history. And so what it appears to me is that if it's above 400,000, and again, we haven't gotten full clarity on this, that it'll be based on wages or W-2 or self-employment income, right? So if you have a household with a working spouse and a non-working spouse, then depending on what the W-2 looked like, then it would be applicable to that. Or if you had two working spouses, one makes 200,000 and one makes 500, then it would not apply, I don't think, to the 200,000. It's just any income above that 400. So that's my understanding, but we still haven't got a lot of clarity on how that's actually going to work in practice.
Okay, John, I want to see if we can touch on this a little bit. Is the proposed, or not proposed, I guess, what's being talked about for the student loan forgiveness, and kind of what if that goes through, depending on whether it's the 10,000 that's been talked about or up to the 50,000 that could be. Kind of what could that do to taxes, if anything? And then as a second part to it, what would it do if the forgiveness follows kind of the PPP route where it becomes tax-free?
Yeah, so there's two good questions. So from what I have been seeing is that they're likely, if they pass this, and I don't know to what magnitude, that would be considered tax-free, right? So that whether it's 10,000 or 15 or 50, that most of what I've read is that this will likely go the tax-free route. Now, because the PPP was also kind of income tested or the health of your business tested, and if you, especially in California, if you didn't have a decline in your business, you had to pay tax in California. So I'm not exactly sure how that's going to pan out, but what I've been reading is that if whatever proposal they have will likely be tax-free. And then the second part of that is, well, what happens to taxes? So I don't know the answer to that. I mean, I think one of the challenges that we all, I think, just casually recognize is that, I mean, essentially with the Federal Reserve and the federal government, we have the printing press, right? We're printing money. And so if we're going to go pay off student loan, are we going to do it through raising taxes, or are we just going to print money and go pay it off? And that's really the dangerous thing. We know the Federal Reserve has been out there buying mortgages and buying bonds, and they're printing this money, and the balance sheet has grown to, I think, like $6 or $7 trillion. And so it's a little hard to know the magnitude of the student loan and how they're going to handle it. And but I don't honestly think it's going to probably be through massive tax changes. I think it's just going to be probably run through like an emergency stimulus, because it also runs into a little bit of a slippery slope around, what happens if you have somebody last year that paid off their student loan debt? Are they going to get money in arrears? What about people who paid it off 5 years ago? Are they going to get it forgiven? So there's still a lot to be determined on the student loan. My sense is what they do will probably be lower, meaning it'll be maybe 10,000, a modest forgiveness, because that'll help. But I think there's a lot of pushback on some of the bigger numbers, certainly on the full forgiveness. And so I don't think it's going to impact taxes, because really on the whole scheme of thing, forgiving 10,000, looking at our whole budget, I don't want to say it's a non-event, but it's not that massive unless it's going to be an ongoing policy.
Okay. Switching over, John, another question we got was, how do Social Security and Medicare tax contributions apply to self-employed individuals?
Yeah, so self-employed individuals, for the most part, pick up their income, if they're not incorporated, on their Schedule C, right? And even if they have an LLC, a lot of times it's picked up on their Schedule C. So when you pick it up on your Schedule C, let's say you have a business where all this income comes in, and then your net income, so your income minus all your expenses, your net income, you pay self-employment tax. So the self-employment tax basically is kind of a doubling of those numbers. So we talked about Social Security at 6.2 and 6.2. Well, you add that up, and that's 12.4. And then we look at Medicare, and that's 1.45 plus 1.45 of 2.9%. So you add those up, and that gets us to to roughly not quite 16%. So it gets us right around 16%. So on self-employed, under the current provision, is you essentially pay that up to that threshold of that 140 plus thousand, and then anything above that, you're not paying self-employment tax. You do pay federal income tax on money above that, but you don't pay any more self-employment tax. And so with the proposal, if your income and net income is above 400, that's where it's going to get a little dicey. So from a planning perspective, one of the things that I don't advise on the structure of what entity type you should have. A good CPA or attorney can help with that, and we can be part of the conversation, but that's probably going to be an issue for some people. So if you're self-employed on a Schedule C making north of 400,000, it might behoove you to switch to an S corporation and pay yourself wages of like 150 or 200,000, and then have money coming from your corporation as a profit, which would not be subject to self-employment tax. So there's some things that there's definitely going to need to be some planning, and that's why I'm excited. Once we get something passed and we have some clarity on what is happening, then we can come back out and really offer some more solutions around what should you be doing given your individual scenario. But again, that's why we're offering a consultation, because everyone's income, everyone's situation is so vastly different that it's hard to have kind of a blanket statement on one size fits all tax advice.
Right.
Planning guidance.
Gotcha. John, does the same apply? I know with legislation, we obviously don't have as many as we did before, but does the same apply for independent contractors?
Yeah, so independent contractors kind of get put into the same category, right? So if you're self-employed, right, that means you're generally getting a W-2, right? And then if you're an independent contractor, if you're self-employed, you're generally getting a 1099, and independent contractors the same thing. So I think those terms can be kind of used loosely. I think the differentiation becomes we have a lot of independent contractors and self-employed that decided to set up a S corporation. And then what happens is all their money flows into their corporation. They have to do a corporate tax return, and then they put themselves on payroll for their own corporation. And then it allows them to have some flexibility on how much Social Security wages are they going to pay? Are they going to have to pay tax on? And how much will they take out as a profit? So those two categories, self-employed, independent contractors, can be in the same bucket, but it just depends on how they file their taxes. Again, whether it's on a Schedule C or whether it's through some sort of a corporate entity.
Okay. John, I want to move into corporate rate. Why is the focus only on large multi-billion corporations regarding the corporate rate when all small businesses incorporate for legal reasons and will be hit hard as well?
Yeah, so interesting with that comment. I don't know if that's necessarily true around, let's unpack this corporate taxation. So just dealing with the two major type of corporate structures. And again, this is a good question for your attorney if you want to get into the weeds a little bit more. But yeah, most large corporations are C corps. A lot of small businesses are not C corp. So a C corporation, whatever profit you have at the end of the year in a C corporation, you pay tax on. So, and that's at the corporate tax rates. When you have an S corporation, and that's what a lot of small businesses are, certainly not all, but an S corporation is what's known as a flow-through entity, which means if an S corporation has profit, the S corporate doesn't pay taxes. So there's essentially no corporate taxes due on an S corp. What happens is the S corp income flows down to the individual owners. So if it's one owner, it flows right down to their personal tax return. So depending on the changes with Social Security, that could have an impact if they decide they're going to tax that profit. Depending on some of the changes that we're looking at can have an impact. But when we're talking about corporate taxes, it's truly, I don't want to say 100% focusing on these, but it's really focusing on those C corporations, a lot of the bigger companies, because again, most of the small businesses are structured under an S corp, which they don't pay a corporate tax rate anyway.
Okay, John, not to backtrack, but I did get a clarification from the first question I asked in regards to the 400,000, and it was, and I don't know if this will change your answer, but it was the 400,000 was for personal tax increase, and Biden always uses that as a benchmark for personal tax rate, but waffle to household rather than individual. That's kind of the clarification. I don't know if that changed. Go ahead.
Yeah, so I mean, I can kind of jump in there. There's not full clarity on that, so I don't want to be vague on it, but there's not full clarity as to exactly what the game plan is. But the reason why the 400,000 number is always used is that's the threshold when looking at, essentially it's households, but where you bump into the 1%. So I think that's really kind of a rallying cry that says like, hey, the people in the 1% bracket can afford more. And that 400,000 of income is that threshold from a household perspective. And they don't really differentiate whether that's married filing jointly or single. They're just kind of doing it as a full household. So that 400 level seems to be that target where they're saying, hey, if you're above 400, we're going to increase your taxes. If you're below 400, we're not going to. Where on the Social Security piece, this is where we don't have clarity yet. It seems to me like they're only going to be assessing that on wages, which means W-2 or self-employment. So it doesn't seem like it's going to be assessed on profits from an S corp or profits from real estate or profits from something else. It seems like it's just going to be on wages. And so again, we don't have full clarity on that, but I think that's why it's a really bad idea, because it would, it's going to incentivize. It's a weird dynamic, but that's where we just don't have some clarity on it, and I think there's gonna be a lot of fighting as to what the best plan is.
Okay, thanks for that. Real quick to estate plan and family trust, does a properly prepared estate plan or family trust avoid inheritance or death tax?
Ooh, that's a really broad question. So again, that's really a legal question, but I'll share some thoughts. But I think that's a question take to your estate planning attorney. We obviously have several that are members of the chamber that I would recommend, and we can obviously connect you with them. But in terms of like a basic estate plan, which would include like a living trust, the main reason that people put those in place is for privacy is a big one because it's not public. It can avoid probate as long as you title assets appropriately. But if you have it in your living trust and your estate is larger than these thresholds, that current 11.7 million roughly, if you're bigger than that, you're going to pay estate taxes, right? So just the simple fact of having a trust, having all your assets, if you have a large enough estate, you're going to be subject to those estate taxes because again, it's based on that number. Now, if you go into more sophisticated planning and you start doing gifting of assets, gifting of your business, gifting of real estate, there's ways to remove assets from your estate in a tax advantaged way to potentially lower some of the estate taxes in the future. But some of the basics of the estate plan, again, if you're in a typical trust structure, that in and of itself is not going to save you estate tax liability. But again, that's really a great question for your estate planning attorney.
Okay, John, I kind of want to close with this and see your thoughts on it if you can answer. But sort of as we're approaching a post-COVID world, hopefully, do you predict or envision a certain tax increase and or a new tax, gas tax, tourism tax, something along those lines? Do you see, I guess in the state of California specifically, something like that coming out?
Yeah, I mean, the short answer is I don't know. I do think that if we look at, one of the challenges that I think we recognize across our country is we have a demographic challenge, right? We have an aging population. We don't have good birth rates, so we're not replacing ourselves with younger workers. Immigration's a little bit stalled right now. We don't have enough people coming in to kind of support an aging and retiring population. So we definitely have some demographic challenges that are going to put strain on local governments, on state governments, and then clearly on our federal government when you look at the impact of Medicare spending and Social Security on our budget, right? So we have those challenges that are going to need to be addressed. And in terms of what gets put in place, I mean, I don't know the answer. I know the federal level, there's been some chatter of putting like a national sales tax in place, right? To just tax goods instead of just having a state sales tax, you would have a national, which would generate a lot of revenue. Is that a good thing to do? Again, that's debatable. And then I know California has discussed having some sort of inheritance tax so that they can capture some of the wealth that's been accumulated in their own state. But outside of that, I think what happens when you start introducing new taxes, it becomes really unpopular, which is I feel like why they're trying to adjust current tax policy to make tweaks or adjustments so that it's maybe not viewed as a new tax, just an altering of a current tax policy.
Okay. John, thank you as always. I know you started with saying this is a dry subject, but I think it's one that definitely needs to be heard. And, someone myself who I have a degree in policy, I still can't get myself to understand tax policy. So just sitting here, I get to learn a lot from it. So thanks for being here and thanks for sharing all the information with us. Again, everyone, as John mentioned, as he has the slide up, Vance Wealth is willing to do a 30-minute complimentary consultation for you guys. So scan the QR code, reach out to John. If you have any other questions that come up, please reach out to me. I can get them over to John and we can kind of point you in the right direction or get you the necessary answers. But with that, John, thanks again for your time. We look forward to seeing you next month, July 21st. And everybody, we hope you guys will be able to join us for then. And with that, be safe. And hopefully we'll see you guys all soon. So thanks again.
Thanks, Peter.